Some succeed, some have benefit. Hello and welcome to Market Guru. Hello and welcome to this edition of Market Guru. I'm Vivek Law. Joining me today on the show is Rashesh Shah, Chairman and CEO at Edelweiss Financial Services. But before we ask him where he is finding the market going, let's get a quick check on all the market action.
Well, in terms of the US markets, we've had quite a brutal session. As a matter of fact, the Dow Jones taking a 200-point hit, and along with that, the Nasdaq as well as S&P taking a hit of well over 1.4% on the speculation that traders are now, starting to think about the Federal Reserve and cutting its bond buying program. So there are a little bit of concerns playing out as far as the US markets go. With that, tremendous amount of volatility in the currency markets as well, with the dollar index remaining flat. But it's the dollar yen, and the yen strengthening against the dollar by nearly 1%. So significant move right there. Dollar rupee on the other hand, we have a little bit of strength coming in as far as the dollar goes. Currently still standing around 61.44. So we'll have to wait to watch as to what kind of move we see in the dollar rupee as well. A crucial variable for today's day of trade. And of course, in terms of commodities, we haven't had much in terms of the movement in crude. It was marginally in the red. So for Brent as well as NYMEX down by 0.1%. Brent still hanging on very close to that $110 per barrel mark. And of course, in terms of gold, we have seen a little bit of an increase when it comes to COMEX gold, moving up around nearly 0.2%. So a little bit of strength seen there. In terms of Asian indices too, taking cues from American indices, we are seeing a lot of weakness right now. Nikkei is already down around 1.2% for now. We're seeing a lot of weakness in Hang Seng as well as Kospi. Kospi, surprisingly, is a little bit subdued, but we can expect a little more, weakness even as we go into the week's trade. And as far as SGX Nifty is concerned, as expected, we are looking at a little more weakness given the cues that we're getting from the rest of the global indices. So for now, down right by nearly 0.7%, taking a hit around nearly 40 points. So wait now, watch out for that and what implications this could have in our opening. Till then, it's back to you.
Joining me on the show today is Rashesh Shah of Edelweiss. Thanks very much, Rashesh. It's always a pleasure talking to you. I want to go back to our last conversation, which was in May, and you almost predicted in some way what was likely to happen. Let's go to that first. You said, and I quote you, the biggest fear is on the rupee and the foreign currency front. This was back in May, mind you. And then you also went on to say that even a $10 to $20 billion outflow will create a lot of pain for the Indian financial system through the currency. We've seen part of that playing out, isn't it?
Absolutely. I think that we have seen improvement on almost quite a few other areas like inflation, even the government, on the fiscal gap. So overall, I think that there has been improvement, but the current account deficit and the rupee and this huge dependence on foreign flows is a big structural weakness in India that has to be fixed, because until it is fixed, we will be exposed to this huge volatility. Of course, we didn't know that the US Fed is going to announce their thinking about withdrawing of the QE3 and tapering and all. But I think India is always exposed to that because we are now very, very, very susceptible to any change in global liquidity flows.
How real is the problem, given the fact that we've seen this 10 billion go out, bulk of it going out of the debt markets? And I also remember you made a very important, interesting point. You said governments the world over are answerable to bond markets and not to equity markets. How are you reading that scenario playing out, Rashesh?
I think it's the same thing that is now starting to happen, because now, as you know, we are seeing FII investors in the bond market. I think even currently the government is trying very hard through the quasi PSU bonds that we are planning to offer overseas. So onshore as well as offshore, we will increasingly see a larger involvement of the bond investors and the bond markets, because interest rates affects everybody, like what has happened recently. In order to protect the rupee, RBI has increased interest rates and the liquidity has been tightened, and that has impacted everybody. While if you go back and see when equity markets falls by 8-10%, it does involve some amount of pain, but it is not all through the economy. So anything on the bond market and the currency market has a much broader and impact is all over the place. So we are starting to see that, because until about couple of years ago, the only investors in bond markets were Indian banks and Indian investors, but now increasingly FIIs. So the same impact they have in equity markets, they are now starting to have in the bond market. But on the bond market, I think any in and out from them has a much broader implication for the economy as a whole.
Is it fair to conclude, Rashesh, that all those big numbers in terms of net FII flows that we saw last year in 2012, and people were talking in terms of at least matching that number, if not exceeding it, is it fair to conclude that that's not going to happen? We are not going to end up with $20-25 billion.
I think on the equity side, we may still be able to, because there is still interest in equity and we are still seeing inflows in good quality companies. Unfortunately, there are only 100 companies in which FIIs are now interested. But on the equity side, I would take a guess, and I would say still about 10 to 15 billion should be possible, because there is, see, the equity money that is coming in, it is largely coming in on the back of some sort of a belief in the long-term India story. And there are quite a few good companies. We are seeing flows into IT sector, pharma sector, where good quality companies are there and which are growing at 15, 20, 25, 30% a year. So there will always be FI investors in that. So some amount of flows will come into that. But I think $20-25 billion looks like on the more optimistic side. My estimate would be about 14-15 on the equity side. But the more important is the FII investment in the Indian bond, in the bond market, is not always coming because of the long-term India story. It is usually coming because of the interest rate arbitrage. And as the interest rate arbitrage starts to weaken and the gap starts to close, we will be susceptible to outflows, as we have seen in the last couple of months.
You talked a little earlier about those measures that RBI took recently, which pretty much knocked out a lot of investors as well, especially into debt funds. It was an attempt to try and stem the rupee. There was a general feeling all through the early part of this year, Rashesh, that this year we'll start seeing more and more rate cuts. But suddenly that picture seems to have changed as well. When we last spoke, you were expecting 50 basis points by the end of the year. Is that something now that you've really cut down sharply on as far as your expectation is concerned?
I think we are still hoping for the cut in the repo rate, maybe in the second half of the year, because we do believe that this liquidity tightening and the increase in the short-term rates, though RBI has not increased the repo rate, they have effectively increased the repo rate by almost 300 basis points through the MSF, the marginal standby facility, and now increasingly banks are borrowing in that. So the effective repo rate is now 10.25, but the official repo rate is still 7.25. So we do hope that maybe in the second half it should come down as the rupee stabilizes, hopefully. But we also think that the cost that we are paying as an economy for this stabilization of rupee is too high, because it has not helped the rupee as much, but it has done a lot of harm to the economy, as you said, bond investors in mutual funds, companies. I think the liquidity tightening that is we are seeing and witnessing, and if it continues in this way, I think come September, October, we should expect a lot more pain in the economy for corporates, for investors, for everybody.
There are also increasingly more and more reports coming out now that as far as GDP is concerned, at least some have started coming out saying even sub 5%. So the macros also don't seem like looking very good at all.
Yeah, I think things were going well until say end of May, and I think with the global liquidity issues around QE, the withdrawal of QE and the subsequent RBI action on liquidity tightening has impacted the economy. I think cost of funds has gone up significantly for most of the people. We'll see a lot of pain in the banking system for both because of the asset quality issues which has been ongoing for the last about 5-6 quarters, but also on the treasury impact on MTM basis that the banks will take. So that will affect credit availability, that will affect cost of credit, that will affect have a much broader effect on the economy as a whole. And I think growth rate estimates are being downgraded, and I think there is increasing consensus that even if we get to around 5, it will be a good thing. Fortunately, on the other side, agricultural growth should be good, so that's one positive angle on this. And the second is it's an election year, and there'll be some amount of election spending that will happen. And if you take that, at least there'll be another 40-50,000 crores of what we estimate election related spending, which should at least spur GDP a little bit more. So there are two countervailing forces on this scale down of the GDP, the agriculture part because of the good monsoon and the election year.
We had last spoken in early May. It's interesting that you put the timeline as end May, because at that time you told me that in the last 7 or 8 months, this is from early May, in the previous 7 to 8 months you said you had turned slightly more positive. From whatever you've seen happening, Rashesh, post end May, would it be fair to conclude that you're not as positive now as you were back then?
True. I think as I said, in the last 4-5 weeks, the RBI liquidity tightening measure and the cost of funds going up, and actually more importantly, the lack of availability of funds, because all banks are holding liquidity, all investors are holding liquidity. We've seen huge outflows from the mutual fund. As we all know, ultimately cost of funds and availability of funds does drive economic growth. Given that we are seeing a huge amount of stress on that, and on the other side the rupee is still at 61.5 and has not appreciated in spite of all the heavy measures that we brought out. It does give you some thought to pause in the short term. I do think the effect of this over the next couple of quarters will result in slowdown in economic growth, in corporate earnings. So when we spoke in May, the optimism was on the back of the rate cycle easing off in India, because what was the good news and what continues to be is that inflation has come down, and our view has always been that the monetary policy should be more guided by inflation rather than currency, because currency is a fight that very few central banks in the world have been able to conquer. I think so most of the central banks now have come to the conclusion that you should allow currency adjustments to happen on their own. And actually we believe that a slightly weaker rupee is going to be good for exports, and we are seeing a little bit of spur for exports. Exports are starting to pick up. So I think rupee here should help exports and should help on its own some structural adjustments around the CAD. And on the other side, I think if interest rates come down, it will be good from a growth point of view. So that was the hypothesis in May. But currently I think that hypothesis has changed, because we have forsaken some amount of growth because of the liquidity tightening approach.
Quite contrary to many market gurus, even back then when I asked you about corporate earnings, you did make the point that you expected them to be weak for at least 2 more quarters. Because most market gurus have been saying now for 6 quarters to me that the worst is over. But you were one of the few who even back then said we will see pain for another 2 quarters. Is that a position you hold, or are you saying that it could be actually another 2 to 3 more quarters by the time we actually start seeing corporate earnings pick up?
I think another 2 to 3 quarters is what I would say, because as I said, though this RBI liquidity measures are short term, it will have at least a couple of quarters of impact. Plus I think asset quality issues are not over. We are still seeing a lot of asset quality issues, and the cost of funds going up will have some amount of pain and slowdown in corporate earnings. So I would say another 2 to 3 years. I think FY14 investors should keep expectations low from an earnings and growth point of view. It's a year we just have to grind our teeth and just go through this. It's going to be a year with some amount of pain, some amount of hardship for everybody. But it's I think given the global issues and the India issues, it's a year we just have to go through, and investors should look at FY15 onwards and then see which are the good areas of investment that are available to them, assuming we go through FY14 with not a lot more pain from here onwards.
Rashesh, I find corporate mood seems to be really down, extremely down. You would of course be speaking to a lot more, you would be advising many more corporates as well and talking to them at various occasions. What's the mood, what's the sense that you're getting from corporate India? Are they even willing to, do they have the confidence to want to relook at plans, put more money on the table and start investing, or is it still status quo?
See, as you said, Vivek, the mood is bleak. Obviously, there is gloom, doom. The only thing that I would say is the mood is bleak almost everywhere. All emerging markets are having their own issues. So part of the India issues also is not very different from other emerging markets. But there are quite a few India issues which are India related and India specific. So in a way, the mood is bleak, as you said. There is a gloom doom around that. But I also find that corporate India are fairly hardened lot. I think people in corporate India have seen quite a few cycles, and now everybody is saying what I said earlier is we just need to go through FY14, grind our teeth. There is going to be pain. We anticipate the pain. So the only good news is all this is in a way priced in the expectations. Expectations are very low right now, and people have solidified themselves to say that we will go through this pain and then look for the upside and the growth which hopefully awaits us after the next 3-4 quarters.
You told me last time that we are in a sideways market and we will continue to be in that kind of a situation for some time to come. Is that a view you still hold, or do you believe that as a lot of things that you articulated over the last few minutes unfold, pain could be even worse, we could see some downside from here on?
See, I think the good thing that has happened in all this, the equity markets are holding up fairly well, because as I said earlier, there is still global interest in good quality Indian companies, because if you're buying a good solid Indian company, they are as good as any other global investments that is available for global investors. So in a way, we are seeing maybe the broad market is not doing as well, but what constitutes the index and the key and the large companies, they are still doing fairly okay, where global investment interest is fairly high. So on that basis, I would say equity markets are holding up fairly well and should continue to hold up, but we will see portfolio allocations changing. Like what we are seeing right now is a lot of investors are exiting banks and getting into IT, and so the IT, pharma, FMCG story still continues for a lot of global investors, while at the same time, given the interest rates scenario, the optimism around banks has come down in the last few weeks.
How serious is the issue in the banking system, Rashesh, in terms of NPAs? Most experts now say that we are still way away from seeing the worst out there.
Actually, we as Edelweiss has always maintained that it will take another 2-3 quarters. We are hoping by end of FY14, a lot of the asset quality issues should come out. And as we are saying, quarter after quarter, there is still a lot of pain in the banking system in terms of asset quality. So I think we think there is another 100 basis points to 150 basis points of NPA that will still come out in the next 3 quarters. And after that, I think we might be able to say that now I think the worst is over, because as I said, the current slowdown will bring everything to the surface. The good thing is the banks, the private sector banks are doing well. The public sector banks, at least a few of them, the larger ones, are fairly well capitalized, and since they are government owned, we won't see any crisis as such, but it does put some constraint on growth and credit availability, and the banks and the bankers are focused on more cleanup rather than growth as of now.
Are you beginning to see any kind of turn in sentiment from the retail investors, or are they just still sitting out?
No, I think retail investors have been, I think, hammered a lot. They invested in mutual funds, in bond funds and all, expecting interest rates to come down. They have paid a price for that. Equity markets also, though it's not come off too much, it hasn't given them the return. So I think retail investors do have investable funds, and they are trying to figure out what is a good way to invest and still keep, I think, liquidity and safety of capital in mind. So I don't think there is a lot of optimism. And we have always maintained that equity investing is always going to be when there is optimism about the future, and we do believe that optimism about the future growth and corporate earnings growth rate and all of that is at least 2 to 3 quarters away. So equity, retail investors will come into equity markets only after that.
We had discussed gold as well last time, Rashesh. That's been one of the big talking points ever since we last spoke. Lots of measures proposed by the government. Some have worked, some have not worked. We've seen price correction there. How are you looking at gold from here on?
See, as you see, in India, gold is for consumption and as well as for investment. I think the investment aura of gold has come off as gold prices corrected, as you know, as global economy is also doing well. The US economy has come back, as the US dollar has become stronger. Gold has not been as attractive for investors all over the world and in India. So from an investment demand point of view, and if you look at the flows into ETF, gold ETFs and all, we are not seeing a lot of investment appetite in gold. The consumption part of gold is part of India's social structure. I think, you know, people get married, whether you are rich or poor. I think buying gold for marriage is a convention, is a cultural, you know, norm that is hard to break. The government is trying very hard with quite a few new ideas around gold bonds and gold deposits and all, which will take part of that away. But if you go to any mall or you go to any gold shop, we're still seeing that some amount of gold buying for consumption, for jewelry and all is a given. So our estimate was between 60 to 65% of gold imports were for consumption last year, and about 30-35 was for investment. And the investment part will come down significantly in this year, but the consumption part will continue, because though this import duty has been increased and rupee has weakened, so the rupee price of gold has gone up, the US dollar price of gold has corrected. So for investors, the gold price is almost, for the consumers, the gold price is almost the same as it was a year ago. And at that price, as long as, you know, people in India are getting married, families will buy some amount of gold. Maybe they'll cut down how much they buy a little bit, but I think it's not prudent to assume that people will stop buying gold in India.
Rashesh Shah, always a pleasure talking to you. Thank you very much for coming by and sharing your perspective with our viewers here on Bloomberg TV India. Thank you. All right, that was Rashesh Shah. We take a quick break, but lots more coming up here on Market Guru.